Hello, and welcome to today's presentation. This is Gabriella Dara, and on behalf of HBKS Wealth Advisors, thank you for participating in our discussion on home mortgages. Today's presentation is a great introduction for first-time homebuyers or those looking to refinance an existing mortgage and take advantage of historically low interest rates. Our presenter today is Quinto Ambrosetti. Quinto will be focusing on three specific topics. First, securing a new mortgage. Second, refinancing an existing mortgage. And third, highlighting the tax benefits associated with home ownership. His presentation will address many of the common questions and needs he's encountered while working with clients to develop and manage tailored financial plans. At this time, I will turn the presentation over to Quinto, who will start us off with talking about how to secure a mortgage.
Thank you, Gabriella, and hello, everyone. As Gabriella mentioned, my name is Quinto Ambrosetti. I'm one of the principals and senior financial advisors here at HBKS Wealth Advisors. I thought with today's low interest rates, the continued booming housing market, and the hopeful return to a stronger economy, that this would provide a great opportunity to talk about mortgages. I was once a loan officer myself over 15 years ago, so even though some of the laws may have changed, the basics of purchasing or refinancing a house has not. So our first topic will be what you should keep in mind when you're buying a house and need to obtain a mortgage. I know that in my part of the country, northwestern Pennsylvania, we're experiencing the same kinds of inventory shortage that other parts of the country are seeing as well. Whether you are a first-time homebuyer, looking for an investment property, or ready to jump on a new listing, you should familiarize yourself with what you should expect when making these decisions. The most common questions that come up when someone is looking to buy a home are how much can I afford? What type of mortgage should I get? What do I have to do in order to apply for a mortgage? And how much of a down payment should I make? I hope to simplify the answers to these questions as we go along. So first, I'd like to talk about the amount that you can afford to spend on a house, which is often tied to figuring out how large of a mortgage you can afford. To determine this, you'll need to consider your gross monthly income before taxes. How much do you owe in long-term debt, like student loans, car loans, and credit cards? And what will the housing expenses be, which consist of mortgage payments, taxes, insurance, and maintenance? In general, banks want to see that your debt ratio for housing expenses do not exceed 28%, and your overall ratio of debt is less than 36% of gross monthly income. As a word of advice, the mortgage you qualify for is not always what you can actually afford. So before signing any loan paperwork, take an honest look at your lifestyle, standard of living, and spending habits to make sure that your mortgage payment won't go beyond your means. So for example, let's take a look at the following scenario. Here's Mary, who makes $60,000 per year, which works out to $5,000 per month. Her mortgage payment, which again includes the principal, interest, taxes, and insurance, should not exceed $1,400 per month in order to keep her debt ratio at or below 28%. In addition to your loan officer, your financial advisor, realtor, or anybody else helping you with mortgages, there are many real estate and personal finance websites on the internet that can help you with these calculations. Some of the ones I tend to recommend are Bankrate, mortgagecalculator.org, and Charles Schwab. You can follow the hyperlinks in this slide, which will take you directly to these calculators. So next, it's also important to understand the different types of mortgages that are out there, because there is not one type of loan that's right for everyone. The type of mortgage that's right for you depends on many factors, such as your tolerance for risk and how long you expect to stay in your home. Here are some characteristics of various popular types of mortgages. The first one we have is a conventional fixed rate mortgage. They tend to be low risk because the interest rate doesn't change, so your payment remains the same. Usually they will be 10 to 30-year terms. A larger down payment may be required compared to government mortgages, which have lower down payments. Then we have adjustable rate mortgages, which are also known as ARMs. ARMs tend to be higher in risk due to the fact that the rate can change over time. These may be especially undesirable right now since we are facing historically low fixed interest rates. The initial interest rate is often lower than a conventional fixed rate mortgage. However, after that initial fixed period of time, the rates may go up or down. Interest rates are usually adjusted on an annual basis and may be limited by caps. Payment caps can result in negative amortization in periods of rising interest rates. Then we have Federal Housing Administration, which are called FHA, or Veterans Affairs loans. These programs will come with a variety type of mortgages that you may be able to qualify for. They typically have lower down payment requirements. They have less stringent qualifying ratios. For example, they may be able to stretch your overall debt ratio beyond the typical 36%. This can be attractive to first-time homebuyers who do not have a lot of money saved up yet. Then we come to jumbo loans. So for 2020, any loan over $510,400 for a single-family home or condo is considered a jumbo loan. The size of loan increases the lender's risk, so interest rates are generally higher than conventional fixed-rate mortgages. When it comes to actually applying for a mortgage after you look at the programs, I suggest doing some homework on the rates and fees across various lenders. Again, Bankrate is a useful resource for comparison shopping. I also recommend having a conversation with your financial advisor who may have a good grasp on what banks offer the best rates in your area. You do not want to apply with multiple lenders and let them pull your credit because multiple credit checks can actually lower your score. You'll want to save that for the lender you finally decide to go with. You are also allowed to obtain one free credit report for yourself per year in order to make sure that the information is accurate. If you're just house shopping without a particular house in mind, you may want to get a pre-qualification or a pre-approval. A pre-qualification provides an estimate of how much you can borrow, usually at no cost. A pre-approval lets you know exactly how much you can borrow and involves completing an application and sometimes paying a fee. So once you apply, the loan officer will begin processing your loan. This will involve gathering a lot of information about your financial history in order to provide information to the underwriters who decide if the lender will approve your mortgage. I have listed some examples that you should expect to have ready, such as bank statements, investment statements, tax documents, information on consumer debts, divorce settlements, and home purchase contracts. After completing an application with the loan officer, they will send you a good faith estimate within 3 business days of receiving your completed application. This form will notify you of your interest rate, your APR, monthly payments, and a list of your estimated closing costs. Keep in mind that these costs are subject to change based on which title company and closing agent you use and when the loan is closed, which could impact how much is collected in escrow for taxes and insurance. And next, lastly, when it comes to purchases, I want to discuss the down payment. This can, in many cases, not only determine what the best mortgage product is for you, but how much you can afford in addition to your ratios. In the past, lenders required a down payment of at least 20% of the purchase price of a home. Today, lenders offer different types of loans with lower down payments. If the down payment is less than 20%, the lender will require that you buy private mortgage insurance, also called PMI. This is ensuring the bank that you will not default on the loan. However, it provides no benefit to the borrower towards actually paying down their loan. Therefore, I would recommend trying to avoid PMI. The most common way to do this is doing a piggyback mortgage, sometimes called an 80-10-10. What that means is that your first mortgage is for 80% of the purchase price. A second mortgage or home equity loan is for 10%, and then you have a 10% down payment. Even though you're only putting 10% down, this will avoid PMI. Larger down payments will reduce the mortgage interest paid over time and may also result in a lower interest rate. However, even if you can afford a larger down payment, make sure you weigh out all of your options. You may want to make sure you have enough money in emergency cash reserves, or you may want to put it towards another investment if you think these investments will result in a higher rate of return than accumulating equity. So next, as I previously mentioned, these unprecedented times have also brought us historically low interest rates. And while that is hurting the amount of interest a savings account or a CD may pay, it's been extremely beneficial to those who are in a position to refinance their mortgage. So I would like to touch upon 3 specific areas regarding refinancing. First, why should you consider a refinance? When should you go through actually refinancing? And then how can you tap into your equity through a cash out refinance? So let's take a look at some of the reasons why you should consider refinancing, even though it might be a little obvious, like being able to lower your mortgage payments by refinancing at a lower interest rate, or shortening the length of your loan to reduce your total interest and get out of debt earlier. There are other reasons, like you may be able to tap into your equity for excess cash, or even using this time to lock into a low fixed rate if you currently have one of those adjustable rate mortgages. When you should actually refinance is determined by a lot of different factors. It used to be said that you shouldn't refinance unless interest rates were at least 2% lower than the interest rate on your current mortgage. However, in many instances, it might make sense to refinance even if the rate reduction is lower than that. So in addition to interest rates, you should consider the length of time you plan to stay in your current home, the costs associated with getting a new loan, and the amount of equity you have in your home. Ultimately, it might make sense to refinance if you are certain that you'll be able to recoup the cost of refinancing during the time you own the home. So it's very important to do the math ahead of time and calculate your break-even point, which is when you'll begin to save money after taking into consideration closing costs. One asset that often gets overlooked in a balance sheet is the equity a homeowner has in their home. So I want to talk about cash out refinancing. That is the portion of a home's current value that is free and clear from any loans. As opposed to refinancing a loan's current balance, a cash out refi might be a helpful way to use your home's equity. You can take the excess proceeds after paying off an existing mortgage to pay off debts like credit cards, home improvements, student loans, or even as down payments for other properties. Once again, you'll have to look at all of your options to determine if this makes sense for you, because cash out refinances will typically have a higher interest rate. Moving on, the last topic I will be reviewing are the tax benefit of owning a home. Many of the tax benefits associated with home ownership apply mainly to your principal residence. Different rules apply to second homes and investment properties. Here's what you need to know, making a home really pay off at tax time. So the most important tax benefit that you get comes with the ability to deduct mortgage interest that you pay. If you itemize deductions on Schedule A of your federal income tax return, you can generally deduct the interest that you pay on debt resulting from a loan used to buy, build, or improve your home, provided that the loan is secured by your primary residence. For mortgage debt incurred prior to December 16, 2017, up to $1 million of home acquisition debt qualifies for this interest deduction. If your mortgage loan exceeds $1 million, some of the interest that you pay may not be deductible. For mortgage debt incurred after December 15, 2017, up to $750,000 of home acquisition debt qualifies for the interest deduction. And if your mortgage loan exceeds the $750,000, some of the interest that you pay on the loan may not be deductible. It is also no longer a given that you can always deduct interest from a home equity loan. Home equity must be used to substantially improve your home in order to qualify for the interest deduction. Also, if you itemize your deductions, you can generally deduct real estate taxes that you've paid on your property and the year that they're paid. However, from 2018 to 2025, individuals can claim an itemized deduction of only up to $10,000 for state and local taxes, whereas previously there were no dollar limits. Next, I'd like to talk about deducting points. Points are certain charges you might pay when you get a mortgage. 1 point typically equals 1% of the loan amount borrowed. When you buy your home, you may be able to deduct points in the year that you pay them if you itemize. Refinance loans are treated differently. The points you pay on a refinance loan are not deductible in full in the year that you pay them. Instead, they're deducted over the life of the loan. So in other words, you can deduct a certain portion of the points each year. I suggest talking to your accountant or CPA to determine your itemizations. Beyond points, you generally cannot deduct any other closing costs. Something else to keep in mind if you're doing home improvements is that the tax credits for all residential renewable energy products like wind turbines, solar energy systems, and geothermal heat pumps have been extended through December 31st, 2021, and feature a gradual step down in credit value. And finally, if your principal residence is going to be sold at a gain, you may be able to exclude some or all of that gain from your federal income tax. Capital gains on the sale of your principal residence equal the sale price of your home minus your adjusted basis in the property. If your adjusted basis will typically include the amount you paid plus any capital improvements. If you meet all of these requirements, you can exclude from federal income tax up to $250,000 or $500,000 if you're married and file a joint return of any of the capital gains that results from the sale of your principal residence. Anything over these limits is generally subject to a capital gains tax. So in general, this exclusion can be used once every 2 years. And to qualify for the exclusion, you must have used the home as your principal residence for a total of 2 out of the 5 years before the sale. That ends this presentation. I appreciate you taking the time to listen to this. So please call me or your own advisor if you have any questions regarding this topic.
Great. Thank you, Quinto, for sharing all of these great insights and providing such great guidance to our listeners. We invite you, if you're interested in getting more information about financial planning services that HBKS Wealth Advisors offers or insights that we've published, we encourage you to visit www.hbkswealth.com. Here you'll find a range of topics from financial planning to commentary and insights on the current market conditions. Plus, you can always email or call one of our financial advisors directly, finding information about who they are, and we'll be able to submit a form to contact them and have them follow up with you. So on behalf of Quinto and the HBKS Wealth team, we want to thank you again for attending today's presentation, and we look forward to seeing you again on another HBKS webinar. Thank you and have a great day.